Gildan Media, a division of Recorded Books, presents Mastering the VC Game. A venture capital insider reveals how to get from startup to IPO on your terms. By Jeffrey Bussgang. Narrated by Ramon Ocampo. Preface. Since the publication of Mastering the VC Game in 2010, I have received wonderful feedback from the entrepreneurial community. In fact, I have been blown away by the response from such a diverse population of entrepreneurs and would-be entrepreneurs around the world. One 20-something entrepreneur working at a nonprofit in Australia wrote me, "Thank you for writing this book. It was a captivating read that gave me the basics of how the industry looks. I loved it. My only problem was feeling inspired to action, which made me put the book down to send emails to friends and look up companies, which was a great problem to have." Inspiring entrepreneurs into action was my original goal for the book. Now, as the global economic crisis recedes in the rearview mirror, both policymakers and business leaders have come to recognize that the capacity of human beings to innovate is our best hope for addressing and ultimately solving society's thorniest problems. It has never been more critical that we brew up that magic elixir that comes from mixing entrepreneurs, who are the source of innovation, with investors, who are the source of capital to fuel that innovation. I wrote Mastering the VC Game to inspire, in some small way, entrepreneurs around the world to arm themselves with the knowledge, skills, and tools they need to take action and to succeed in their endeavors and attract the necessary funds to accelerate their vision. It turns out that I was fortunate in the choice of companies and founders profiled here. When I began writing, 4 of them, Baidu, LinkedIn, Twitter, and Zynga, were relative unknowns outside the insular startup community, but have since become household names with multi-billion-dollar valuations. Their success further validates the lessons included in the book, although there is also much to be learned from the failures that those early founders suffered, and openly discuss here. Since publication, a few significant trends have emerged. One of the most important has been the rise of angel investors as an influential source of capital for entrepreneurs. This has come about through the confluence of 2 forces: the rapid reduction in costs required for a lean startup to initiate operations and achieve early success, thanks to cheaper infrastructure, cloud computing, social media marketing, and more sophisticated techniques for getting initial customer feedback, and the return into the startup ecosystem of dollars and talent from successful entrepreneurs at startup companies like Google, PayPal, and others. Interestingly, these developments have been disruptive to many early-stage venture capital investors who have focused on consumer internet and mobile startups, particularly in Silicon Valley. Many VCs find themselves competing with their former entrepreneur friends who have made enough money that they can afford to invest in young startups themselves. In response, VCs have adjusted their model by participating alongside angels in seed rounds that are often less than $1 million, or focusing on later-stage investing. Further, successful angels have attracted enough interest and capital that they have become more institutionalized, earning the nickname super angels, or raised outside capital and hired young associates to scale their model into something that looks remarkably like a small VC fund. Entrepreneurs that can successfully navigate this new landscape have more funding choices than ever, especially at the earliest stages when they seek only a modest amount of capital. By and large, I believe that it's a good thing for us all that entrepreneurs have these new options from which to choose. We have witnessed some important new technological trends in the past few years, particularly the launch of the iPad and tablet computing, the continuing explosion of smartphones and applications, and a massive cost reduction in the mapping of the human genome, which has the potential to change the game in healthcare and a broad range of industrial fields. Not surprisingly, most of the companies leading the way in these exciting areas are VC-backed. These trends, and others like them, have further fueled the need for the kind of cooperation between VCs and entrepreneurs I describe in the book. When entrepreneurs and investors align and work in harmony, the long odds for startup success are greatly improved, and real magic can happen. If you can master the VC game, you might be the one to create the next Google, Facebook, or Twitter. Happy listening, and good luck. Best, Jeff Bussgang. P.S. Visit my blog to keep the dialogue going. www.seeingbothsides.com. Introduction. I was born to be an entrepreneur. Becoming a venture capitalist, VC, was never part of my life plan. Reid Hoffman, founder of LinkedIn, observed that an entrepreneur is someone who will jump off a cliff and assemble an airplane on the way down. This is certainly an impulse to which I can relate. I credit my father with sparking my entrepreneurial drive. He was a Holocaust refugee and survivor who came to America penniless in 1949 and earned his master's in engineering from MIT and PhD in applied physics from Harvard. He then started a successful high-technology company the old-fashioned way, living hand-to-mouth, operating with customer revenues only, and without benefit of any outside capital. Watching my immigrant father embrace entrepreneurship inspired in me a passion for the field and an unyielding belief in its power to effect change. Armed with a kitchen table MBA, as well as the real thing from Harvard Business School, I set out many years ago on my own entrepreneurial journey. During the 10 years I spent making my way as an entrepreneur and executive team member of two venture-backed startups, You Promise, which I co-founded in 2000, and Open Market, IPO 1996, I interacted with and pitched to many VCs and became fascinated with the VC game. So, after a decade of scratching the entrepreneurial itch, I went over to the other side and became a VC myself. I joined a new VC firm called Flybridge Capital Partners that a couple of friends had just started. I initially both revered and feared VCs as powerful, intimidating characters in possession of the one thing entrepreneurs are desperate to get access to: capital. As I spent more time with VCs as my partners and co-investors, I learned what made them tick and how entrepreneurs can be most effective in pitching to them, managing a VC-led board of directors, and successfully navigating an exit. I wrote this book to demystify the VC world for entrepreneurs, having seen both sides as an insider, and to help entrepreneurs level the playing field when pursuing venture capital so that they can secure the resources necessary to achieve their vision. In this book, I reveal industry insights drawn from my experience as a practicing VC. I also include the perspectives of partners from some of the leading VC firms around the world who were kind enough to divulge their own secrets about their approach to the business. I was also fortunate enough to be able to convince some of today's most successful entrepreneurs, including the founders of Constant Contact, LinkedIn, Seartress, Twitter, Zynga, and others, to talk from their deep knowledge and experience about how to work with VCs to shape a young company and help it grow. The purpose of this book is to share the magic formula of how great entrepreneurs team with VCs to create valuable companies from raw startup. Whether you are the next Mark Zuckerberg, the Harvard student who started Facebook, or Jim Barksdale, the seasoned Fortune 500 executive who became CEO of Netscape, mastering the VC game will provide you with an insider's guide to the world of VC-backed company formation, growth, and exit. In the book's first 2 chapters, I will explore the psyche of the 2 protagonists in the startup game, the entrepreneur and the VC. In chapters 3 and 4, I turn to the process of raising money, the pitch, and negotiating the deal. Chapters 5 and 6 provide insight into the company building process and the way entrepreneurs and VCs make money by selling their companies. The exit. After a profile of the VC business outside the United States in Chapter 7, I conclude with a few observations about the industry's future direction. I have written this book not only to share this knowledge so that others can pursue their dreams and, if things go well, turn their investments into handsome returns, but also because I strongly believe in the positive impact the venture-backed startup can have on our economy and our society as a whole. VCs acting in concert with entrepreneurs function as an essential and powerful engine of the U.S. economy. In the more than 40 years since the very first venture-backed startup, Digital Equipment Corporation, DEC, which was founded by Ken Olsen with a $70,000 investment in 1959 and went public in 1968 with a market value of $37 million, a 528-fold return, VCs have invested more than $450 billion in some 57,000 companies in the United States. More than 12 million people, about 12% of the U.S. workforce, now hold jobs and make careers at venture-backed companies, and those businesses have combined sales of $2.9 trillion, or over 20% of the total business revenues in the United States. And the VC game has led to the creation of some of the most iconic of American companies: Amazon, Apple, eBay, Facebook, Google, Intel, LinkedIn, Microsoft, Staples, Starbucks, Twitter, and YouTube. The venture capital-driven entrepreneurship model has also become one of America's most influential and important exports. Increasingly, the venture-backed startup is becoming a key driver of growth and innovation in countries around the world. In the rapidly developing countries, venture capital investment is spreading like wildfire, up from zero just a few years ago to $4 billion in China and nearly $1 billion in India in 2010, and those numbers are expected to grow rapidly in the next few years. Both in the United States and abroad, the venture-backed startup plays an important role beyond innovation and wealth creation, changing the world for the better. Entrepreneurs and VCs alike invest in dreams, from new sources of energy to curing cancer to revolutionizing education, that have the potential to benefit society as well as themselves. Although the majority of entrepreneurs do not go the VC route to raise money to fuel their businesses, for many reasons that we'll discuss, all can benefit from learning how the VC-backed startup formula works. Over the next decade, hundreds of billions of dollars will be invested in new or young companies, and it is critical that this capital be invested wisely. With the accelerating development of technology, widespread digitalization, broadband internet, wireless devices and communications, environmental and energy breakthroughs, and medical advancements, the stakes are getting higher, and the potential for world-changing opportunities is greater than ever before. Mastering the VC game will help entrepreneurs be more effective in financing and launching startups and in creating companies that benefit us all, while also providing insight into the critical role these enterprises play in the global economy. 1. The entrepreneurial itch. Change the world. To truly understand the world of VC-backed startups, it is necessary to first delve into the psyche of the entrepreneur, because it is fundamentally different from that of the conventional business person. I have had the entrepreneurial drive for as long as I can remember. I was fascinated by technology as a kid. I tease my parents that my love for computers originates from all the video games I played while hanging around ice rinks, waiting for my older sister, then a competitive ice skater, to finish practice. When the Apple II came out, I begged my parents to buy one for me, and I gladly invested the earnings from my paper route in the purchase. I got my first crack at working in a startup during the summer of my first year in business school. I became a member of the executive team of a software startup. The entire staff of 10 worked out of an apartment in Boston, located in an alley behind a Chinese restaurant. I can still remember the smell, and not fondly. The vice president of marketing usually brought her dog to the office, and she, the dog that is, always seemed to bark loudly when I was just about to close a deal on the phone. The first startup experience proved to be great fun. It was a sandbox where I learned about the real-world pressures of operating a small software company, shipping products, working with partners, meeting payroll, and doing deals. From that first experience of the entrepreneurial life, I was hooked. The nature of the entrepreneur hasn't changed much, if at all, since I was a student. This is very evident at a networking event that our firm, Flybridge Capital Partners, holds every year for graduating students at Harvard Business School and MIT Sloan School of Management. We invite dozens of young men and women who are thinking about becoming entrepreneurs. What always strikes me about the event is that the students seem almost completely unaffected by the economic ups and downs raging around them. For example, in 2009, one of the worst years for the economy in decades, they were unfazed by the collapse of the credit markets, the destruction of trillions in stock market and real estate value, and global recession. In fact, those topics didn't even come up. No, they wanted to talk about clean technology and sustainability, the rise of Facebook, novel medical devices and sensors, Google versus Microsoft, the opportunities represented by the emerging mobile generation, and the shift of the hundreds of billions of dollars in global advertising to the web. Many were focused on opportunities in developing countries, the emergence of a global perspective on venture capitalism and entrepreneurship, and all kinds of other fascinating topics. In short, what continued to drive them was the entrepreneurial itch. Yes, they were concerned about landing a job somewhere after graduating in a few short months, but they were much more focused on ideas, innovations, and opportunities. It is no coincidence that the MIT $100,000 business plan competition, and dozens like it around the country, has a steadily growing number of entrants each year. Student-led entrepreneurial teams clamor to submit business plans in the hopes of winning a little seed money and a lot of notoriety. I can only conclude that, in the minds of the graduates of American business schools, it is always morning in America. Thank you, Ronald Reagan. And that our entrepreneurial economy is forever a city on a shining hill. Thank you, John Winthrop. Even when there is economic upheaval. In fact, now more than ever, the entrepreneurial economy is an appealing destination for top talent around the world. It's not, primarily, about the money. One thing you do not hear these graduates talk about, at least not directly, is the money. Of course they want to make money, and being optimists, they assume they will, but that is never their focus. I completely identify with this point of view. As a kid, when listening to my parents discuss the work of my father's company, I was surprised that they talked mostly about people and relationships rather than technology and money. How could the vice president of engineering communicate better with the vice president of marketing? Is the technical team getting along as well as they should on the new project? It was then that I learned the centrality of human relations in business, a theme that has guided my career and a theme that plays out over and over again in this book, in the stories of the entrepreneurs and VCs that I interviewed. That influence is probably why I made decisions to prioritize pursuing my intellectual interests over money, especially early in my career, preferring instead to focus on the thrill of playing the entrepreneurial game. The first time was in early 1995, not long before I graduated from HBS. I was invited to dinner with several members of a prestigious Boston-based venture capital firm. The dinner went well, and the partners asked me to fly to Silicon Valley and meet with some other members of the firm. Long story short, I received an offer to join the firm. I had been so focused on becoming an entrepreneur, however, that I didn't know how to evaluate the opportunity. I didn't even really know what the VC industry was all about and how it worked. I consulted with some friends, and they told me to consider two factors. First, the money. They said that senior partners at top-tier VC firms earn a staggering amount of money over the course of a long, successful career. One of my friends referred to the VC world as a get-rich-slow business. Second, the nature of the work itself. As one of the firm's partners put it, the work was a mile wide and an inch deep. You could work across many different arenas, but never get to dig in and actually build something of your own. Tempting, but after some soul-searching, I decided I preferred to follow my passion for entrepreneurship. I concluded that I didn't care about the raw economics of the opportunity as much as the nature of the opportunity. I wanted to get my hands dirty and build new products and lead teams. So I declined the offer, expecting that would be the end of the relationship with the VCs. Not so. They graciously offered to introduce me to a few of their portfolio companies. One of them was Open Market, a Boston-area internet startup whose mission was to develop the infrastructure software that would help turn the internet into a safe business environment. Exactly my area of interest. I jumped at the chance to join the company as an entry-level product manager with a salary of $65,000 a year. More money than I had ever made, but still a fraction of the average starting salary for a Harvard MBA at the time. My classmates thought I was crazy, but I couldn't resist the allure of a startup. It was simply in my blood. Fortunately, my instincts proved right. Open Market was an incredibly exciting company. We hired 200 people in the year after I arrived and quickly grew to over 500 employees. I was fortunate to rise swiftly through the ranks and soon joined the executive team. 12 months after I came aboard, the company went public. Although we had just $1.8 million in revenue, we achieved a market capitalization, total value of all outstanding stock, of over $1 billion. At age 26, I had become a paper millionaire. More important, to me anyway, I had learned a lot and had a tremendous ride. But, like all addicted entrepreneurs, I wanted more. I wanted another ride. The Siren Song of Serendipity. I have a strong belief in the power of random connections, the siren song of serendipity. I have always admired the way successful entrepreneurs put themselves in a position to get lucky by developing relationships with relevant people and taking advantage of promising opportunities. So, in 1999, while still at Open Market, I accepted, for no particular reason, an invitation to meet with Michael Bronner, one of Boston's most successful entrepreneurs, founder of the leading interactive marketing firm, Digitas. Michael wanted to start a company that would help parents set aside money for college tuition and also enable large consumer companies to create strong customer relationships through loyalty programs. Over breakfast, Michael described the idea in great detail and the unique culture we could create by building a company that would do well by doing good. I have to confess that he had me at hello. It wasn't that I wanted out of Open Market. I was perfectly happy there. Once again, however, the siren call of starting a new venture and the appeal of the mission were so strong that I decided to pursue my passion and joined Michael to help start the new company, becoming its founding president. We called the company You Promise. We initially worked out of Michael's house in a suburb of Boston and made plans for global domination. We hired 20 people in the first 3 months of the venture and rapidly built out our team and infrastructure. The technical team began developing software in the spare bedroom. The living room was taken over by marketing and the dining room by business development. When the trucks and crews rolled through this exclusive neighborhood, hauling computer equipment or installing high-speed lines, we became very unpopular neighbors. First, the speed bumps arrived. Then, a town zoning inspector paid a visit. Eventually, we were chased out of Michael's house and had to find proper office space. In our first year, we raised nearly $100 million in 2 rounds of financing from several blue-chip venture capital firms, hired 50 more employees, and signed a flurry of business partnerships. After many twists and turns, including surviving the bursting of the technology bubble, You Promise became a successful company. Sally Mae acquired it in 2006, a few years after I had left, and by 2011, the firm administered $35 billion in college savings plans and had 12 million households using the service. An entrepreneur's makeup. Although I spent the first 10 years of my professional life as an entrepreneur, I didn't fully understand the entrepreneur's mindset, my own mindset, that is, until I went to the other side and became a venture capitalist. More on how that happened in the next chapter. As I listened to pitch after pitch and watched as some venture-backed startups took off and others didn't, I became much more aware that the successful entrepreneur is built, in fact, has to be built, in ways that are fundamentally different from other business people. Many startup entrepreneurs would simply hate being a big company executive. The conventional wisdom is that they just don't have the management skills necessary to run a large company. Although it's true that most entrepreneurs could not successfully manage thousands or even tens of thousands of people in a complex organization, there are exceptions. Bill Gates is the best example of a brilliant entrepreneur who has succeeded along the whole arc, starting from scratch to leading one of the world's largest and most important companies. I think the difficulty that startup executives have in fitting in comfortably into a big company is more about what drives an entrepreneur and what satisfies him or her, both in the long run and in the day-to-day work. It comes down to an essential character trait that I observed in myself, the entrepreneurial itch. When you have it, you just have to scratch it. You really can't help yourself. Being an entrepreneur may be something deep in the genes. John Doerr, the venture capitalist, described some of the greatest entrepreneurs he had invested in, including Sergey Brin and Larry Page, Google, Jeff Bezos, Amazon.com, and Steve Jobs, Apple, as geeks who couldn't get dates. Although I don't know if that is actually true about those four guys, the spirit of the comment resonates. The world of the entrepreneur, even when they are teenagers, is typically not defined by being cool and fitting in, but rather by their passion for technology, innovation, change, and a particular idea. Genetic or not, there are certain classic characteristics of the entrepreneur. The most important of these are a certain kind of visionary optimism, tremendous confidence in oneself that can inspire confidence in others, huge passion for an idea or phenomenon that drives them forward, and a desire to change the game, so much so that it changes the world. Later, I'll introduce 3 entrepreneurs. Flybridge is not an investor in any of them that fit this model. They may not be household names like Bezos and Jobs, but each of their companies is well on its way. Sertress, Twitter, and LinkedIn. Visionary, passionate optimist. A drug that keeps you young. Entrepreneurs tend to genuinely believe that their brilliant vision can make the world a better place. What else can you expect from a person who works, typically day and night, and often for a relatively low salary, to create something that does not exist and for which there is not even a model? If the entrepreneur isn't optimistic, isn't a true believer in his own vision, who will be? However, I've found that although the entrepreneur displays these positive traits to the outside world, more negative concerns may also be driving him. For example, the entrepreneur's incredible optimism that everything will go right is often accompanied by a raging fear that, in fact, everything will go totally wrong. Strangely, many venture capitalists respect and respond as much to the paranoia as they do to the optimism, perhaps because they, too, can be ambivalent in their outlook. Take, for example, Dr. Christoph Westphal. Here's his audacious belief that his company, Sertress Pharmaceuticals, can create a drug that will keep you thin and help you live forever. Well, at least for a substantially longer time, perhaps 10 or 20 years, than you would live without the drug. Of course, that's not exactly how Sertress describes its product. The company's research focuses on developing drugs to target enzymes called sirtuins, including resveratrol, a naturally...
Sample complete. Ready to continue?